Welcome to the Dividend Talk podcast, episode 204. How our savings rate has evolved over time. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. How has the market been treating you this week?
Wow, it's quite interesting, right? Because it feels like everything shot up. It's really amazing. I don't really look at capital appreciation, but in my portfolio, of course, I see how it's developing. And you know what? It's up around 3.5% since my quarterly update. So we're talking about effectively about 2 weeks of stock market. You know what they always say, like it's time in the market is more important than timing the market, and that sometimes just a few days in a year make all the difference for your entire portfolio. And if you miss those few days, it can have a long lasting impact on your portfolio, right? I think we just experienced that the last few days, because I think the last few days I made this 3.5% or 4%, whatever it was. Let's say that my portfolio does on average 10-11%. Then I got already 40% of the growth just in in a few days, effectively.
Yeah.
Which is crazy, and it's just an evidence of how quickly a market can move. Yeah, and we know that sentiment changed after the latest inflation numbers. That's now 3% lower than expected. So this means that the market is cooling down, which means that people start to price in interest rate cuts and such. So that's what the market responds to. But I mean, it's crazy, really, right, for a portfolio. I mean, the sad thing is, not a lot of dividend hikes. We'll talk about that later, but none in my portfolio this week. So, but have you experienced the same with your portfolio?
Yeah, the last I don't usually check my portfolio too often, but the last 3 days I have been, and it's been quite exciting to see it go up so rapidly. I don't remember a time when I've seen it consecutively 3 days where my portfolio has literally gone in a straight line. You got to look at, as you said, interest rates are cooling, so any of us with real estate investment trusts seem to have done well. NN Group have seemed to be doing well, and also Blackstone and CRH have been flying for me for the last couple of days as well. So it's been good. What's quite funny is I'd be looking at social media and you'd be listening to different things, and REITs were dead there not so long ago. Everyone's saying stay away from them, and now all of a sudden they're starting to pop, and all I'm reading is it's a shame. I wanted to buy more, and it's just funny when you read these things, because when it's happening, people tend to stay away, and then when it goes up, it's like, oh, I wish it was still staying lower. But yeah, I mean, your portfolio gains could be. I think there's a stat on that, or there's some chart on that. Like if you miss the best 2 or 3 days of the year, it outweighs the worst days. So it shows the importance of staying in.
Yeah, and to your point, we've been buying a lot of those punished stocks last year, like insurance stocks and the real estate investment trust. And I'm looking now at my portfolio, and you're right. I see Realty Income that has nicely recovered. It's trading around $56 now.
Agree Realty
at around $65 now. So I can clearly see now that I'm all in the green there, and then group there. So a stock that is not doing so well yet for me is Legal in General. I own quite a significant portfolio position of that one as well. I am at the plus though, so that's good, but it could do better, in my opinion. So yeah, I can see now actually that those stocks and actually, what do you think about Texas Instruments at $200 now?
Oh, has
Yeah,
that?
yeah, yeah, yeah. I was buying them. My average cost per share, I think, is $155, and mostly acquired not too long ago, a few months ago, half a year ago, maybe 9 months ago. And we know that Texas Instruments is really going through an investment cycle, right, where they are not making a lot of cash flow.
Yeah, yes. That's have to catch me by surprise, I have to say, because I can't remember when we spoke about this. Maybe it was December or
Yeah,
January, maybe, and they were on that downward slope. And
yeah.
honestly, hand on heart, I thought they'd stick around that level, considering we know.
Me too. I thought it would be that money for a year, and I could nicely
Yeah,
invest in it. Maybe it gets back there. We don't know, but it is just surprising me that they are recovering so well.
but I think that's a very good example of staying in the market. If you sold that thinking that it was going to drop or keep dropping because it's going through some sort of cycle, and now it's up 10% in the past year. So it's yeah, it's good, quite a good example. But yeah, good times in the market, good times to be an investor. And the problem is sometimes you get these and you think you've been right in your conviction with some of these. I know these real estates have been struggling, but it's nice to see them finally
No,
jump
but
up.
I mean, we're well positioned, I think, for a recovery in that
Yeah,
sector, and that's the difference between us and many other investors. Because when you're price-oriented investor, you ignore those. I said those sectors, yeah, because
yeah,
you're more looking for the momentum. But in our case, we get better yields, and we can put them on the shelf. And in these kinds of times, it confirms that there's enough appetite in the stock that investors have believe in it, and then we ride the wave up, and then we get this feeling like, oh, I wish I bought more, because
yeah,
it's kind of then the confirmation that there's an interest in this stock, while maybe at a lower price we will be maybe a bit doubting, like, oh, am I seeing something that the
others
market
are.
is, yeah, or the way around, right? Am I blind to something? And that's why that's always this doubt. We have it as well, right, when stocks are down. But that's why we always say you need to do your own homework here,
Yeah,
and over time we learn better how to deal with that as well. Yeah, with this emotion and having this conviction. And one of the things that helps, of course, if you have 40 stocks in your portfolio and you're investing in something, it's maximum 1% of your portfolio. Yeah. In the beginning, when you have only 5, 6 stocks, it's a total different emotion as well.
yeah,
But it's really nice to we have those days that we look at our portfolio and we think like, wow, yeah,
yeah,
from that. And, but, the only thing is my dividends didn't go up. But for instance, I was very happy that I got my Defama dividends from Matthias Schrader, the CEO that we had on the podcast. So I was very happy with those dividends. And then I looked at the share price there. So I thought like, it's going up as well, but good that I bought enough for what I wanted it to be at the time. So
yeah.
yeah, overall, I mean, it's just share price. So, but yeah, you see
Yeah.
what it does to my emotion in
It
the end.
it it's just share price, but there's one thing that's pissing me off, and I refrain from using language on this podcast as much as possible. Um, but I spoke to you off air. I'm trying to break that psychological barrier of 100K. I won't give my exact figure, but I'm like, I can touch it,
Mhm.
I can see it
Yeah.
now. But I was looking, there's two companies in my portfolio that I've spoke about maybe 20, 30, 50 times in this podcast that I had options and lost nearly 95, 97%. They're still in my portfolio. They're worthless. They're worth like $40 or $50 each. But if I had just took that money and not put it into options and put it into any of the other companies in my portfolio, I'd be sitting well over the 100K mark. And that's quite frustrating, I have to say. But listen, it's all about learning lessons and stuff. It's part
Habits
of the journey.
important lesson, because many people are inspired by some other investors that are showing how they are generating income via the wheel strategy and such. We even did a podcast episode on it, right? And it is very interesting as well. But I think what you learn there is do the wheel strategy on companies that you want to own.
Yeah, yeah.
Yeah,
And
and not on any stonks that are yeah,
it's similar to dividend investing. Don't go chasing yield, or you'll get burnt. And getting
yeah,
burnt is not nice, let me tell you.
yeah,
But hey, look, we've got some news of the week this week, and I'm giving out about losing money that I know that's at risk.
yeah.
What about Unilever? They're cutting 3,200 jobs.
Yeah, this is typical for a company that is kind of struggling. Yeah. So if it's not easy to find the path to growth, you still have another area where you want to, increase your operating margin or something called the savings rate that we will later talk about. And that's what they are doing here, right? I think it's almost half of the office jobs all around Europe, but mostly in London and Rotterdam is the expectation. Yeah, let's say like that. This CEO is taking action finally. Yeah, because the former CEO Alan Yopi, you remember also how we thought about them when I mean, can you imagine this guy almost single-handedly killed Unilever if he would have done the GSK acquisition for 30 or 40 billion, way overpriced. The debt load will be enormous now. Yeah, I'm sure that the
Would have
share
killed them.
price by now would have been maybe 30 or 25 euros just because of that. Yeah, because now with a 5% debt refinancing, this is no joke. I mean, so good that the investors at the time shamed on him, right? That he in the end didn't do it. That they called him back, but yeah, this CEO is of a different piece of wood. I like him from that point of view. I don't like that he is, of course, not so clear about the dividend. A bit sneaky there, right? About it. I'm also wondering what will happen, right? Because they will sell the ice business unit. I
Yeah,
believe it was 7 billion or 8 billion of sales on what was it, 59 billion, I think, of total sales. So it's about 15%. So I'm wondering now assuming that that is, let's say, similar margins across the business lines for the sake of the argument, right? I'm hoping that they're not cutting the dividend by 15 or 20%, yeah, or even more to 50% to reset the dividend and make it competitive. So for me,
yeah,
definitely the dividend is at risk. You sold it already, I believe.
yeah.
I haven't pulled the trigger yet. It's mostly because I've been too busy with work, not really getting my head around it. I'm going on vacation soon, so I will have a long drive of 12 hours. And when my wife is sleeping, I have something to think about what to do with Unilever. I'm thinking of, for instance, halving my position. I don't have the same conviction anymore. It's not a tier one or a tier two anymore. Let's downgrade it, take
Yeah.
some of the money, invest it elsewhere.
It's polarizing, this company, because it's on Facebook, on our group, there was a
Yeah,
little chat about this, and it's been dead money for 5 years. Lots of people are excited about this new CEO, and the share price has popped this year, or at least done better this year than it has over previous years. But then I look
yeah,
back over the last 5 years, and the share price is still below where it was 5 years ago. So I look,
yeah.
I'm not 100% convinced they are right back to growth yet. I know they're making some waves, but the fact that they have to cut this many jobs, the fact that they're still cost cutting, tells me they're not really on the growth trajectory yet.
No, not yet.
And
Look,
that's where I'm at. Yeah,
I still have a decent profit in Unilever. Yeah. Of course, my return on investment has been very low.
yep,
Other than the dividends, a little bit, probably annualized 6-7%, which is too low. Yeah, for what I look for, but I can still get out of it with a really nice profit.
yeah, yeah. So we love a rumor on this show, and we have a really big rumor, and that is around NN Group. Um, we just found out, well, in one of our groups,
Well,
that
yeah, that they
I,
are
I
doing.
I don't know if it's true or not, but apparently they're holding these pre-earnings calls with analysts before they release the results to the public.
Yes, and I read somewhere that it's not technically forbidden. Yeah,
Okay.
because they are, how I said, they are sharing information, let's say, but it's not with the retail investors. Yeah, so it's really a select group, and the rumor is that the solvability ratio is a little bit lower than expected. Okay, but for me, you remember what with NN Group, what I was saying, like I think ASR has better management.
Yes.
NN Group are a little bit these flash boys.
Yes.
I'm seeing that more and more, right? And it starts to annoy me. It's a large position in my portfolio, and it starts to annoy me. I was also listening to another podcast sent by one of the followers on Twitter. And actually, the guy there that was talking about NN Group, they were talking about why a banking license. And you know what the guy said? I think it's purely because yeah, they have a young workforce. They want to make a career. The business is too boring. And I had such a deja vu because it was exactly what I was thinking as well. So it's funny how that goes, right? That it's probably too obvious. And this happens in companies. Yeah, people do get bored. People do
Mm.
start to look at stuff, and people do get crazy ideas, and people start to diversify. Yeah, this is normal in businesses, but you need strong management for that, and the right leadership and ASR. And the guy is talking, I mean, he talks boring as he can, but he still is able to make it a bit sexy because he's very educational. He's also very clear, and this is what we don't do. So I'm assuming that when you're an employee, you also know, like, you don't need to go to that CEO with any crazy ideas. Yeah.
Yeah.
So
Yeah. Yeah. I know you don't pay attention to analysts generally, but in this scenario, would it be worth following those analysts? And if they cut their price target directly after their private consultation with NN Group, is that not a clear sign that something's
no,
something
for
big's
me,
coming?
not for me. More of an issue is that they don't do a press release.
Mm.
Yeah, and that they have these calls with analysts, and I think, like, you're not taking your investor base serious. Look at all the retail investors that are invested in NN Group. It really pisses me off. It really
Yeah.
pisses me off. This is just like, this is something you just don't do. You take your investors serious, no matter how, no matter the size. Yeah,
Yeah. Yeah. Because there's a Twitter account on X. He's a Dutch guy. I think you know him very well. Dividend Lever.
leven van dividend.
Yeah,
Yeah.
yeah, and great account. But he calls him NNVIDIA. I loved it because their share price has gone up so good. I quite enjoyed that. And then the last piece of news we have is around the feds. It's always the feds in America, isn't it? But the feds are investigating Stewart Healthcare for fraud and corruption. That's a big one.
Yes, yes, that's a big one. And why I looked at this in the news of the week, because this may impact medical property trust as well. And we
Yeah,
know that a few of our listeners still hold it. I mean, after all that has happened, right? Now, looking at the fraud case of your biggest tenant, which may spill over on you, because it has also to do with, let's say, for instance, the deals that were made, right? The leasing deals that were made. So, I mean, I mean, too hot. I know people can make a quick buck if it pops, yeah. If it's trading at 4 or 5 and you think it will be 10, that's a long. But come on, there's fraud now even involved with their major tenant that went bankrupt, right? And you may be exposed there yourself as well. For me, this is man, it's too hot, too crazy. This story is really, really going crazy. It has, like, all over written, like, avoid at all costs.
yeah,
Yeah, I'm
100%.
talking here as a dividend investor. I'm not talking here about someone who loves the thrill, the thrill seeker.
Stay the hell away from them. Dividend hikes. We've been on a bit of a slow journey. There's been none in my portfolio, but there's two of note. Cummins, ticker symbol CMI, had an 8.3% hike. That is their 15th consecutive years. And I don't know if you know much about Cummins, but they do, at least from what I
What does
remember.
Cummins do?
I should have known where you were going. But they manufacture electrical power generator systems. It's been a company actually I have wrote down for a while.
Those automated ones, right?
automated.
Yeah.
Yes, yes, yes. So yeah, I've been meaning to look at them quite a while, but 15 years is quite good. You And then we've got our first kaboom in the Facebook group in a while, and that is from Pedro. Bank, which I know you'll probably enjoy this one, but Bank of New York Mellon raises their dividend by 12%. A lot of banks have big raises this year, a lot
Yeah.
of banks, but expect big cuts when shit hits the fan. So,
Yeah. It's a bit more volatile.
yeah. Okay, our main topic was around our savings rate, which evolved over time. I suppose the inspiration for this came from a little image or a picture you took, posted it on social media, where it shows the crossover point. And on that, you'll see that your monthly investment is hopefully going up and your total expenses is coming down or flatlining until they meet and your investment income matches your expenses. And that's pretty much kind of self-explanatory, really, but that was the basis around that. But it kind of shows how important your savings rate can be, especially as an investor. And there was lots of discussion around that. But I want to take you back about your initial savings. Like, where did you begin with that?
So it started when I began with investing, of course, when I really focused on it, but actually started before already. You need to know that in the 2005 or something like that, I started working. I earned money, less than 2,000 euro. And with all my expenses, if I was able to save 100 euros a month, it was a lot. I was living on my own the first 1 2 years. So I was able to maybe save 1,000 euro a year. And for this 1,000 euro, I had to replace my fridge or all these kinds of things, right? So if I had 500 600 euro on my savings account in the end, it was a lot. Yeah. And I came out of it as a broke student, not with debt, but just no money. I think I had my in the Netherlands you can be in the red, yeah, for maximum 1,000 euro. I think when I finished my study over all those 4 years, I was able to get it from 0 to minus 900, and then I had to build it up in my first year of working to remove this 900, and then I could start building it up. After that, I got married. My wife had an income, and that's really where we started to save, because with the two of us, we didn't need to consume her entire salary to cover our life, yeah, because most was already paid for it. It's more like the food, the clothes. That's where more the scaling is, yeah, not so much in the house because the house is already paid. So that's really when we start to save a little bit, but it was still maybe a few hundred euros per month, maybe 300 400. So over the year it was a bit longer, and it allowed us to start building up a little bit of a capital, a little bit of a safety net, but it all went to the savings account. Fast forward several years, 5 6 years later, I discovered dividend investing. My salary had grown over that time as well, quite nicely, I think, how it goes when you're from your mid-20s to your early 30s. Yeah, that's the time that you're really making a career. It's also a time where you see your salary growing if you're performing well in a company. And at that moment in time, of course, also our cost basis was inflating. Yeah, I had a lease car that was probably not needed, way overpriced and everything. So this is where I would like to say, if you also, for the people that saw that picture, where it started for me with the savings rate, because that was the moment I really started to, what most people do actually when they discover it. I downloaded from somewhere a budget app, a budget G sheet, and I started put every bill in there, and I started budgeting. I started, for instance, I started to pay down some mortgage because of the 5% interest rate that I had around that time. In the Netherlands, it was still with my house in the Netherlands. I started to create a new internet account at a cheaper value because I didn't need the max one. I started to have a new gas and electricity provider. I started to all save on those kinds of things, because when you're a sleeping client, yeah, they just increase the prices, they give you the maximum rates, but actually shopping in this really, really saved me quite some money. So I've been doing that for 2 years, reducing my expenses, but at a certain moment it just starts to turn flat, right? How much is there that you can save? You don't want to give in on quality of life. But at that moment in time, I think I reached already a savings rate of 25%, 25%. The beauty of it, though, is that I continued investing in my career, and my salary also continued to grow. Yeah. So if I would get a 5-6% salary hike, that went entirely straight away to my savings rate as well. Yeah. And that was really the beauty of it. So let's say in those, I discovered dividend investing maybe after 3 years, it really started to lift off my savings rate. And now I'm at around 50%, 55% or something like that. It's a bit more consistent over the last 2-3 years because of the inflation. I had the luck that my salary or my savings rate is flat due to also an increase in salary. But I also feel like this 50-55% will probably stay a little bit the same. I mean, my salary will and can still grow, but also the cost of my children are a little bit growing. Now they go to different school and so as such. So I try to rather maintain the savings rate now. Now the issue is if you look at this picture, for instance, that the trend of total monthly expenses is supposed to be flat. I think it's more indicational for the gap, because when I calculated my investment plan, right, I am taking into consideration an annual 3% inflation, which means each year my expenses are growing naturally by 3%. Yeah. So it's never really to be supposed a flat line, but my investment income, so my income from dividends, will need to grow stronger than that, of course, and to that point where it reaches the crossover point, which should be in a few years from now, 2-3 years, or rather 3, I think. So that's a little bit how my journey went. But now, for instance, if I get, I don't know, a 5% salary hike, this can lead to 7-10% savings rate increase if I'm able to contain my expense level.
Yeah, and it's quite interesting because it's quite a similar story, I would imagine, for a lot of people. But you've mentioned your kids are getting older, and what I've noticed certainly over the last 12 months or so is my kids are coming into, well, one is well into his teenage years, and my second one is just about a teenager. And I can say that the expenses have gone up faster than I anticipated, because obviously they're still doing the sports they're always doing, which also costs, but now they're a little bit more independent. They're going out a lot more with their friends. Of course, if they go to the cinema or they go somewhere, you give them that extra bit of money, and that's something that I never really accounted for, because I always thought they'd be fine or whatever, but actually,
But do you let them work for it?
of course, but I mean, they're working for me. They're not working and earning it, so it's still coming from my pocket.
Yeah.
So
Yeah.
they do their chores, they do what they have to do, but it's still money from my pocket. So it's something that I didn't anticipate, and I have to say my savings rate this year is probably lower than it was 2 years ago. Even though I'm earning more, my costs have gone up more than that.
Yeah. Yeah, but that's something you need to work on then, because those kids are probably a bit spoiled, those of yours.
Not really, because most of the outlays is in relation to the sports. So you know they're doing quite well in their sports. So there's a professional team. My oldest son is on it. My second son is now being brought up into the first phase of that. But that has additional costs. Traveling, for example,
Yeah.
every weekend we now travel at least 50, 60 kilometers away. Sometimes it's double that. So there's fuel costs, there's additional costs there. So all that kind of stuff adds up over time, and that would never have been budgeted into
Yeah.
my plans. So it did take it down, but like I'm still investing the same amount in money terms that I was 2 years ago, but my wages have gone up a lot more than that. So actually, I'm not investing more. I'm investing the same, but even though my income has gone up,
Yeah.
my savings rate has come down with that.
Yeah. That's very interesting. And then are you aiming to do anything to that? When do you expect your expenses to flatten then?
My kids move out.
Seriously, yeah.
No. I would say when if my youngest son follows the same path in terms of where he's going, I would say that we have an idea then how much things will be, and
Yeah.
we'll baseline over the next. So we could probably use this year or next year, certainly next year as a baseline, and we'll know then it should
Yeah.
flatten out then, and we'll be able to
Yeah.
go from there. And then like that'll only last 2 or 3 years, and then we might have other expenses. But I don't anticipate if they're going to be successful in that sport, they'll have to move abroad, and then it'll be actual professional football. So costs to be taken care of. If not, then they go to college like normal people, and they'll have to make their own way once they get to 18. So
Yeah, and when they really hit the jackpot with football, then they can pay you back.
yeah, well,
Retire you.
that's what they promised me, but I'm not, I could be waiting a long time for that. But yeah, look, it's just different things. It's, I suppose, easy to look at a spreadsheet sometimes and have it mapped out in terms of what
Yeah.
your costs will be, but there's always something pops up unexpected, and for me these were unexpected costs.
Yeah.
Local football is not, we don't have to travel as much, so I think it's the traveling that probably costs a lot more than what we anticipated.
Yeah, but come on, you're not saving on your kids with those kinds of things, right? That would be
Absolutely
very.
not.
Then you would be the Irish Scrooge #1.
No, I don't regret a thing, and I'd never hold back. That's why
Yeah.
my investment has stayed steady, because I know
Yeah.
that's my baseline. But eventually, like I had my 5-year plan 2 years ago, and I would have expected to be maybe 25-30% more
Yeah.
investing every month than what I am at the moment.
And then how? But when you went to the beginning, right, when you really started to focus on this, what were the biggest expenses that you were able to save on?
Oh, it was actually before I started investing is when I really started to save. So I have to give a disclaimer. My wife has always been very, very good at saving. Even since we were young, we're together since we're 13, but she's always been good at saving. I was not so much. I was very impulsive by nature. You might have guessed that by now when we talk about trading and options and all this sort of stuff, but I was always very impulsive. I got into a good bit of debt, I have to say. I was earning a lot of money, and while I was actually earning more money at 19 than I was now. We had this Celtic Tiger in Ireland. I was an electrician, and you could nearly print money. It was ridiculous. But because I was earning so much so young, I bought like cars that I didn't need, like expensive, like I'm talking about 70, 80,000 cars. Like I had a Range Rover. There's absolutely no reason for me to have a Range Rover. But when that crashed, I was in a bit of debt. So you have to come out of that. So it actually, what that forced me to do was increase my savings rate to pay down that debt. I would have started around 14 years ago, 15 years ago now, actually, before my first son was born. So I got into the habit of putting away 20-30% of my wages to pay down that amount of debt. And we got it reduced quite quickly, quicker than I anticipated. And I just kept those habits. So I always have that 20 or 30% that I've used now for saving. So I do save a bit, I pay extra for mortgage, and then I invest the rest. So I think, yeah, I must probably around. Do you know what? If I probably look back over time, I'm probably only about 5 or 6% higher now than I was maybe 10 years ago, if I'm honest.
Yes, but then the income side, how has that developed then? And what have been your biggest learnings on the income side?
So the income can come and go is what I've learned. As I said, during the good times in Ireland, I was earning a lot of money. I was working hard. I must say, I was working a lot of hours, but I was earning over 100K at that time.
Yeah.
But that dropped significantly, and I would say by a fifth.
Wow.
That's no kidding. It dropped significantly. It was hard to get work at the time. There was no construction, and it just completely dropped. And now I'm at a good place. I'm nearly back to where I was back all those years ago. But what it's taught me, what it really has taught me, that when you have it, you have to make sure that you have something for when you don't have it. I think that was the key learning for me, because when I had it, I didn't think about that. I was spending money. We like to drink in Ireland. I was going out maybe 4 or 5 nights a week. I was buying everybody and their dog drinks for absolutely no reason. We're just spending money that hand over fist. Whereas now I have extra on the side that if something was to happen to my job now, I could sustain my lifestyle until I find a decent job again. Whereas the last time I was forced into take lower income jobs just to get money into the house, just so as we could pay the bills. And that was my biggest learning.
Yeah, and then for me now, if I would be in that situation, it's so nice that I know that I have the dividends behind it. Yes, so literally I could take an Uber driver job, drive 3-4 days a week, and probably be good. Yeah, not knowing exactly what an Uber driver makes, so maybe I'm a little bit overestimating, but I wouldn't need to have the same kind of job which requires the same kind of papers like I have today. I could take kind of any job that comes my path and fill the gap if needed. Not sure it will give me satisfaction or it will make me mentally healthy, very healthy, but I'm really proud on the fact that I'm already at that stage that I don't need to have stress in such a case. Of course, if I could really not find a job, then I would need to first go into my emergency fund. In a certain moment, stress will come. I'm sure of that.
Yeah,
but I should be able to make some money.
We talk about freedom, but what essentially you have now is freedom of choice. You won't be forced into taking something that you don't particularly want, and that's
and it's specifically under normal circumstances, because I don't know about you, but I still remember the great financial crisis in 2008. The gates shut down in nearly every company. There was just no work, like nix, nada. And in such a situation, I think it took a year to 2 years for really things to start slowly recovering again. I remember that because there were many people jobless for a very long time. But I would consider those still the outliers, and we prepare a little bit for the outliers with our emergency funds and such, right? Here, but that will probably still give me a bit of stress, because that was an entire. I remember still, and then I think we spoke on the podcast one time about 150 episodes ago. I remember in 2009, it must have been somewhere in March, April, seeing a documentary about the harbor in Norway where there was literally no container ship even coming in anymore. And for me, that was kind of where the bell was ringing, because in hindsight, that was the bottom of the stock market at that time. But I'm not preparing for such a disastrous moment too much, because these happen once in 2 decades, maybe once in a decade, and the likelihood is therefore low. But at least if it happens, I can probably sing most of it out without getting into trouble.
As I mentioned, I was one of the people caught up in that, and the funny thing about that is that I thought I was out of it unscathed. I bought my house in March 2009, so I was still in a job then. It didn't look like I was in trouble. March 2009. By September 2009, that's when it all crumbled. That quickly. So I remember that. But I feel like I am planning. I do have a better plan in place for if that happens. I'm probably a little bit more scared than you are from that. So there's definitely motivation for me to, if this did happen again, if it happened to me or happened to my kids or my family, I definitely have I'll be prepared this time, which is something I wasn't before. There's a lot of peace of mind in that.
So, but maybe to sum it up, look, generally, I expect my savings rate to stay flat now by design. It can still grow, of course, if my salary continues to grow, which I actually think, because in Poland is an emerging country, but I'm not so focused on it anymore. If my salary is growing, probably I let my expenses also a little bit grow, but that's more for the sake of quality of life. Like you, my kids are getting older, maybe visiting a country which is maybe overseas in the sense of another continent or something like that, a bit more But because this savings rate now is doing me really well, and knowing that in a few years I hit my expense crossover point, I don't need to be as entirely strict anymore. And the 50% savings rate is exactly as my plan. So I'm sticking to my plan with that. And yeah, so on the income side, it means like just continue what I'm doing at work. I'm enjoying it, so I hope that the company enjoys it just as much as well, and that it stays healthy enough to continue letting me grow, right? That's all what it is about. And I think this is also important for many other people. And I realize that in not every company also you get a proper salary growth. I know I'm working in technology sector, so it's a little bit easier there usually with budget, maybe compared to when you're, I don't know, in a governmental ministry where the politicians decide whether you get 1 or 2% if you're lucky, yeah. So but again, in my opinion, there are so many ways. You could also just change your job and from a civil clerk become a corporate tiger, whatever it is, right? Maybe it's not your thing, but there are ways you can usually by industry switching, taking an industry that is more in the growth space, and therefore I said ride the wave there, right? Also when it comes to income. So there are things you can do definitely still on the income side. I just don't need it because I'm already in a good space here.
Yeah. Of course, that's a whole different debate about switching jobs and moving jobs. It's not always.
Yeah, but it's important when you think about you're generating your income, because this will drive your savings rate probably more than the expenses that you at a certain moment. I mean, you count at a certain moment, right? That's a race to the bottom. So
yeah, no, I agree. You have to treat your job serious and use that as your baseline. But yeah, no, I think that was nice little chat. I think we're a little bit different. My expenses are increasing, yours are staying flat. But let's check back in 5 years and see if Wayne has steadied out.
Good. Hey, then we started introducing the portfolio review again, and last week we got several people reaching out, and in this case we have Markus. Markus reached out, Markus Kettingen from, I believe he's from Finland, and it was really nice. He did quite a long post on Facebook in his comment there, but also followed up with a very nice email. And what is good to know a bit about his investment philosophy is really sticking to companies that he genuinely likes and sees in his daily life. But he has also changed his investment approach for quite some time, because he started investing around 10 to 12 years ago, approximately, but then bought a house, if I remember correctly. So he had to invest that money, get out of the market, and come back again. Then when he came back, it was the FOMO time, buying startups and certificates, warrants, and everything here. Lost a decent amount of money with that. But now he's in a position that he also has a company, and he wants to have a proper balance sheet there. And dividend investing really is a tax-friendly investment style for him. So what was always difficult for him is like not knowing when to sell. So I think that's something that I also often mean to say. And he has struggled often a little bit with the self-confidence in investing. But now that he can see the snowball effect with his volume, so he gets already a decent amount of dividend income and such, he feels really that let's say the energy is coming into it, right? That stock analysis, analyzing companies, and really sees it as a hobby. Pretty much what you and I have as well. So that's a little bit the background of him. And he always had the idea to have 100% invested in Coca-Cola. So no wonder that Coca-Cola is his number one position, but by nearly 20%. Yeah. But then he has 13% in the VanEck Morningstar dividend leaders. He has 11% in the Fidelity US quality income. I believe it's ticker symbol FUSD, if I remember correctly. Yes, Casco 11%, Madatum 11%, Microsoft 5%, VanEck Semiconductor UC ETF around 4.5, Pfizer 4.5, Starbucks 3 to 4, Vici Properties almost 4, Chevron 3.5, Visa 3, United Healthcare, PepsiCo, and Axia Bank. So this is a portfolio. So now knowing a little bit his background and such, the portfolio as well, what are your first thoughts? And thank you, by the way, Markus, for this really good introduction.
Yeah, it was a nice email, and like I have to admit, he already pointed out most of the stuff I would have said. Anyway, in terms of his allocation to Coca-Cola and his reliance on some of the finished stocks. So look, I think that's quite obvious. 20% in Coca-Cola, in what's this, 20, maybe 12, 13, whatever. There's a small number of companies, but 20% in Coca-Cola is crazy. Well, not crazy, but it's really, really big conviction. I'm not too sure on the UCITSs, the ETFs there. I don't know them that well, so I'm not going to comment a whole lot on them, but I think it's a good strategy to have ETFs, especially as he mentioned that he was a nervous investor and that he doesn't have confidence in. I think sometimes going into ETFs is a good way to mitigate against that. So
and these two dividend ETFs are really good, high quality ETFs. Maybe not the chowder roll, that's another story, but the companies in there are really solid.
Yeah. So roughly around 25, 26-ish% are in ETFs, because he's got the semiconductor one there as well. So look, I think that's a good balance. And he's got some Finnish companies, and honestly, you mentioned you're from Finland. I don't see that as such a big deal that there's an over-reliance there. Once you know the companies and you're happy with them, I looked at Mandatum briefly. I think they're a good company. They have some good growth prospects. They're in that asset management kind of space. Kesco, I'm not 100% sure of. Of course, look, he's got some other companies that I quite like. Microsoft is 5% of the portfolio. Starbucks, which I know you like, I drank a lot of on holidays, I have to say.
Thank you.
And Visa are there as well. Two companies I'm not a fan of is Pfizer and PepsiCo, but that's my own personal opinions. But I think it's well balanced. I think apart from Coca-Cola being the standout leader, I would much prefer to see Microsoft, Visa, up there as your number one position rather than Coca-Cola. But look, Coca-Cola is a consumer staple. It's been steady in share price. I think they've done really well with the restructuring. There's a lot of good things to like. So it's not the worst company in the world to have as your top position. But personally, I feel like it's a little bit on the high side. But other than that, it's a well balanced portfolio, I would say.
And I can also see with the smaller positions, right, like Starbucks, Vici, Chevron, Visa, and such, it seems like they're probably a little bit newer in the portfolio.
Yeah.
Because if I follow his story, then Coca-Cola, Kesco, and Pfizer. So Kesco and Pfizer, I think, were turnaround plays for him. Coca-Cola, then because of the philosophy of having 100%. So it seems to that he's now building up his portfolio, and from what he has been buying, it looks actually pretty good. So if this is the direction, then he's definitely on the right track. I'm missing here a foundation. I think the ETFs probably serve as a foundation, but I'm also in the stocks missing a bit of a foundation, in the sense of it's not clear for me what are the anchor stocks. Yeah, okay. Coca-Cola probably now by size, but is Kesco really an anchor stock, or is it just a result of the turnaround in share price? So that's mostly what I'm thinking about. And yeah, the diversification is starting because he's looking really at each and every sector a bit. I can see that, and that just needs time to build up, right? But yeah, maybe a few classical how is it, dividend aristocrats I'm missing here, like we have the Johnson & Johnsons of this world. Not saying that this is the very highest quality investment that we could consider now, but a few of those stocks I'm kind of missing here.
Yeah, I'm not really. I think the ETFs cover them, like 30%.
True that. You're right. True that.
Yeah. Kind of covers that to me. But I like the Finnish stocks, but I think being Nordic, you could probably look a little bit at Sweden. Swedish stocks are there's a lot of good ones there. We know our friend Alan has companies from all over the world, but certainly around Finland and Sweden is probably the two strongest. But overall well balanced, and I love the bravery of going all in the beginning on Coca-Cola. I mean, that's amazing.
Yeah, yeah.
All in.
Well, Marcus, I hope this is helpful. Thank you also for, of course, the explanation with it. It always really helps us also to trying to understand the context beyond the portfolio holdings itself. So thanks for that.
Yeah, 100%, and quite very transparent, I must admit, and it was
Yeah.
refreshing to read, and quite similar to my own story with a lot of mistakes too. So you're not alone, Marcus. We'll move on to some questions, and the first one is from Dividend Controller. I didn't try to say it in German this time, so I went the English route. But regarding savings rate, how much do you increase it with each year? Do you have a certain
I
percentage?
think we just.
Yeah.
I think I just discussed it. I
Yeah.
think I just discussed it. So around 50%. That's where at least I want to keep it flat. Any salary hike goes straight away into the savings, but it also allows me now to do some other things if needed here.
Baybreak has asked us the question: how did you meet, and how did you end up doing a podcast together? I think we spoke about this quite a few times. We get this question quite a bit, but it was pretty much during a pandemic. We were tweeting away, got in contact, had a chat together, and decided maybe there's other people who want to listen to two Europeans, one with a strong Irish accent and one with a Dutch accent, living in Poland, talking about dividend stocks. And we're still here, nearly 4 years later. So it's been quite a ride, I must say. The Sambo has asked us, how should investors handle a takeover offer?
Yeah, that's a difficult topic actually, because often there is like a spread that you can benefit from as an investor as well, and in the end it often comes down to math. Yeah, there are some templates on the net that you will find on where you can first do discount cash flow analysis of the company that's being acquired and the acquirer, and then make, let's say, the joint cash flows together, join them up, see what the debt is that is going to be taken on by acquiring the other company. You can then kind of get a feeling for what the company should be worth. What most people do, though, is they follow the analysts. In this case, they know, for instance, if the price is, I don't know, set at $70 or 70 euros, and that the share price is still trading at 65 euros, you have this five euro arbitrage. And that's usually what it comes down to, right? The arbitrage play.
Yeah.
When it's being taken over, you often also have the option to get shares in return or something like that. And here I would say you need to ask yourself, do you want to have a position in the acquirer? I had, I think, 1 or 2 times where I said, like, no, I sell out of my shares. I don't care about this arbitrage of a few percent. I just don't want to be an investor in the company that is taking over.
Yeah.
So I think that's also very important.
Yeah. It's case by case, but one of the biggest ones I remember around arbitrage was Microsoft when they wanted to Activision, and there was a theory, or there was a threat that it would not go through the courts and it would not be allowed. So actually Activision Blizzard hung around $10 below what the takeover price was, and the risk there was if the deal fell through, you might lose a lot more money, but if the deal actually was okay, which it was, you then get the benefit of that extra $10-12, which depending on your shares could be a significant amount of money. So it's always quite difficult, especially if it's hanging in the balance and you need approval from the courts to go it. So it's a good question, good thought-provoking question. Robert has asked us about our thoughts on possible regulation of big tech by the government. ESG is a problem for companies, and the French going towards socialism like most of Europe, from far right to far left attacking the free market. This is the biggest threat for investing, especially dividends, for Robert.
Yeah, I mean, yeah, it is a threat to the economic system. I mean, those are things I don't have influence on. The only influence I have is to avoid those countries where this plays a really big role. I'm not so optimistic, but I do believe that capitalism as such has also one good other incentive, and that is to acquire politicians. So I think when it comes down to it, I think specifically in America, they will just fund the politicians to protect their stake into it and into the market. So I'm still slightly optimistic here. I can also see this turn around again. Yeah, for instance, if the threat of China becomes even bigger and people really start to understand what communism means. So it's just a certain wave now going on this decade. I don't like it from the tax point of view. Like for instance, that a politician in France was claiming a 90% tax on people that income tax on people that earn more than 400,000. For me,
Come
this is
on.
crazy. This is
Come on.
crazy. I think they get the issue is they get a megaphone in the media, but come on, I can't imagine anyone doing that in such a country because effectively they will figure it out 1 or 2 years later, because
Yeah.
then all the wealthy people are gone to other countries, and the tax will drop significantly
Yeah.
because they will also drop the tax on the first 400K then.
Yeah.
So
Yeah.
it sounds maybe nice. It sounds very populistic, good for a certain base that want to hear it, but in practice, I can't imagine this. Then just naturalize everything straight away and become a communistic country.
Yeah. Yeah. I agree. Um, Viva Dividend 2 has asked if you could specify how you got on your financial freedom for every year you're investing. So if you're 70% now, where were you 2016,
At
2014?
2014, I was at zero.
Yep.
Yeah, and then there was a curve. It's an exponential curve. So I mean, I would need to really dig it up, but let's say that in 2020 I was maybe on 30 or 35%. We were starting to do the podcast then. So
Yeah.
I think I doubled in the last 4 years. I
Yeah.
think something like that.
I know it was 15% last year and I'm 20% now. So
Yeah.
went up 5% in.
Yeah, it really grows exponentially. Yeah. So in 2014, maybe I was at 2 or 3% at the end of the year after 5 or 6, and then 9, and now I grow by about 8 to 10% each year. Yeah.
JC has asked us about our thoughts on Paycom, ticker symbol PAYC.
I haven't really looked at it. I just checked a little bit the dividend history. It started paying a dividend, according to my information, only last year. There's a PE ratio of 25.5 right now, a 1% dividend yield. So that's definitely not hitting the mark for me. But I further don't know the business, and I'm not so interested in it, knowing the yield, and also that the PE ratio for me is still quite high. Of course, I don't know what the growth numbers are behind it, so that's maybe something still that I would need to look into. But in this case, it's an opportunity cost in where I spend my time. And in this case, it's not interesting enough for me. It has a PAC ratio also of more than 2. So that means that the growth is also not like in the 30 or 40% or something like that.
Yeah. Yeah. I tell you, I've avoided this company for a simple reason that it's a Twitter stock to me.
Okay.
X stock.
Yeah.
I've seen it come up all the time. It's been pushed like that. And usually when that happens, it doesn't work out too well. And it's a payroll company. I don't know how much growth, if it's considered a growth stock, would be in that. If I was
Mhm.
looking at a company in that region, I would just go towards Walters Clore and stick.
Yeah.
Christoph has asked us our opinions on XR holdings. Honestly, Christoph, I didn't see this question too late. We didn't look at it, so I'll highlight it. We'll ask it in the next episode. We'll have a look. And Harry has asked us about Walgreens. It's a deteriorating business, but it is still profitable when things stabilize. So temporarily, there's no earnings due to impairments. Has the market overreacted, and is Walgreens now in a value territory at this point?
The classic turnaround play, where we burned a lot of our hands on. So
Honestly, I don't think the market has overreacted here. I don't know where the growth is coming from. They tried this Village MD, they tried this new health thing. It just hasn't worked. They're now closing down some of the ones that they've set up. They're closing down stores. We talked about Unilever having to cut down staff in stores. Walgreens are similar. Look, I honestly don't think the market got it wrong. I really actually don't even think it's in value territory. I think it's a value trap, if I'm being honest with you. And I sold it, and there's no looking back. I've thrown this one over my shoulder. I take my learnings from it, and I move on. But yeah, just be careful.
Could you see this one going bankrupt?
It's you hear the sayings, is it too big to go bankrupt? And I don't think it will go bankrupt, because I think a lot of people still depend on the stores, because there's pharmacies there at the end of the day. Maybe it could be acquired, maybe. But bankrupt, it's hard to see it, but
okay.
I just don't see it as investable at the moment.
Yeah. A lot of real estate behind it, right? Also with realty income.
Yeah, and of course, Rite Aid, they're going bankrupt, aren't they? And I think that was the beginning of their downfall for Walgreens. Yeah, turnaround play, Harry. We've burnt our bridges on them. Although Intel are flying lately, I believe.
Yeah, but it's, if you zoom out, it's just a ripple.
I love that. Cool. That was the last question. So thanks, guys, for all the questions. Christoph, we won't forget yours. We'll ask it next week. And we'll see you all again. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.